हाँ विजय भाई ठीक है.
Good morning, friends. We welcome you all to today's session, and I would now request Arvindji Shukla, the moderator, to take over. Arvindji, all you.
Thank you, Vijay bhai. Today is a very educative webinar, which many of us are looking forward to. The webinar today is being organized by Tax Friends Mumbai, Tax Practitioners Association Thane, Income Tax Bar Association Varanasi, Income Tax Bar Association Prayagraj, and Bhiwandi Tax Practitioners Association Bhiwandi. It is the joint banner of all these associations. I welcome all the members and also all tax professionals to this seminar, which is going to be a very highly educative seminar. Yesterday, the Prime Minister has said that we should make best use of the adversities and convert the adversities to opportunities with our determination. And that is what we are all doing. We have become students again. We are organizing very good webinars and trying to learn and enrich our knowledge, sharpen our professional edges. So today, I welcome everybody to this webinar, and I hope everybody will enjoy and learn a lot from this webinar. The chairperson for the day is none other than Madam Premlata Bansal ji, our past president of All India Federation of Tax Practitioners and a stalwart in the field of tax profession. The keynote speaker for the day is Mr. Jagdish Punjabi, who is a very renowned orator from Mumbai. First of all, the chairperson will be going her initial remarks, and then the main speaker will speak. Regarding the chairperson, she needs no introduction. All of us are very well known. We all know that she has been the standing counsel for the Income Tax Department in Delhi High Court for a very long time. She has also been the past president of AIFTP, and not only that, the first woman lady president of the AIFTP, and that's a great achievement. She's a very affectionate lady, and I have had the opportunity to get her blessings always. First of all, to start this webinar, I would request Madam Premlata Bansal to give her initial remarks on the subject capital gains in real estate transactions, select issues and recent developments. Over to Madam Premlata Bansal.
So much.
Thank you.
Madam,
Friends, good morning to all. Respected presidents of Tax Friends Mumbai, Tax Practitioners Association Thane, Income Tax Bar Association Varanasi, Income Tax Bar Association Prayagraj, Legal Relief Society Calcutta, and Bhiwandi Tax Practitioners Association Bhiwandi. My dear friends Vijay Keval Ramani, Arvind Shukla ji, Sanjay Kumar from Allahabad, Asim Jafar, OP Shukla ji, dear Jamna, and many others. First of all, I must congratulate you all for organizing this virtual conference.
Madam Nankani ji is also here.
ओ नानकानी जी, मैं तो बहुत दिनों से आपसे बात करने की कोशिश कर रही हूँ. Nice to meet you here. I am proud to say that you have made, Vijay Keval Ramani, particularly for you, I am proud to say that you have made two ends of India, East and West, together to meet at one place. Though we are physically at distance, our soul and minds are at one place. यह कितना सुंदर सुभग समागम है कि हमें अपनी पुरानी संस्कृति, ऋषियों की वाणी वसुधैव कुटुंबकम की याद दिलवाता है. I congratulate you for making this fruitful attempt. Friends, Corona has brought many hardships to us, but it has also brought many good things. Had there been no Corona time, we would not have met so frequently face to face. I think by virtue of these virtual conferences, dullness has not shadowed over our mind. We are making best utilization of knowledge, time, and technology. We can't change the circumstances, but we can change ourselves. Happiness is within us. We don't have to find it. Accept the life the way it comes, and happiness is everywhere. Happiness will come itself in every moment of our life. I once again congratulate the organizers, particularly Vijay Keval Ramani, who had first started this series of webinars. I congratulate Vijay to you. And you have made this Corona Kal eventful.
Thank you, madam. Thank you.
Friends, today's subject is capital gain in relation to real estate transactions. We have with us Jagdish Punjabi, who has command over the subject. I am jack of all but master of none. But Jagdish Bhai is master of all. So I have nothing to worry. But I have to fulfill this formality. Friends, everybody knows that section 45 to 55A deals with the computation of capital gain. If capital gain cannot be computed, then there is no levy. BC Srinivasa Sethi, everybody knows. Originally under 1922 Act, capital gain was not liable to tax. Originally in 1922 Act, it was only in the year 1948 that section 12B was inserted in 1922 Act by the Income Tax and Excess Profit Tax Amendment Act 1947, making capital gain arising after 31st March 1946 chargeable to tax. Sixth head of income, that is capital gain, was added in section 6 of 1922 Act. The levy was virtually abolished by Finance Act 1949, which confined the operation of section to the capital gain arising before 1st day of April 1948. Thus, levy was only for 2 years, that is assessment year 1947-48 and 48-49. But section 12B, sixth head in section 6 and section 24 was as it is remained on the statute books. Now, Finance number 3 Act 1956 reintroduced section 12B. It was made again operational so as to bring within capital gain any profit arising from sale, exchange, relinquishment, or transfer of capital asset effected after 31st March 1956 within the ambit of section 12B. No separate definition of transfer like section 247 presently existing in the statute book. Under the head capital gain and shall be deemed to be the income of the section. Now section 45 deals with the capital gain under 1961 Act, which says that any profit arising from a transfer of capital asset effected in the previous year in which transfer took place. So for invoking the provision, there should be capital asset and there should be transfer of the capital asset. Section 214 deals with capital asset. If the asset which is transferred is not the capital asset, then no levy. Stock in trade, personal effects, agriculture land, certain bonds are not the capital asset. Long-term capital asset is an asset, and particularly for immovable property. If it is held for more than 24 months, then it is long-term capital asset. I am not dealing with these provisions in detail. I am only giving the remarks. Fine remarks will be given by the Jagdish Bhai. I am precisely giving the idea only on the subject. Section 247 deals with the definition of transfer. It includes various modes of transfer, particularly in relation to transactions with respect to immovable property, real estate transactions. Important is subclause 5, which says that transfer includes any transaction involving the allowing of possession of any immovable property to be taken or retained in part performance of a contract of the nature referred to in section 53A of Transfer of Property Act. So, if the consideration is passed and possession is allowed, even if part performance is there, then also it is a transfer. Subclause 6 deals with transaction, whether by way of becoming member of a cooperative society, by way of acquiring the shares in any cooperative society or company or association of persons, or by way of any agreement or arrangement having effect of transferring the enjoyment of the immovable property, then also it is transfer.
Right.
In respect of real estate transaction, the developers and the landowner enters into the joint development agreement. What is this joint development agreement? Whereby the landowner transfer the possession of land to the developer, and developer owns the construction, bears the expenditure on construction of the project, and even simultaneously gives the property, constructed part construction to the landowner. Before insertion of section 5 in section 45, profit on transfer of land by way of joint development agreement was governed by section 45 itself. Transfer of land took place when transfer is given to the developer. Hence, owner of land was required to pay the tax at the time of transferring the possession to the developer. However, majority of consideration was to be received by the landowner in the form of constructed area in future. So the dispute, many times dispute arose as to the valuation of the constructed part. So to remove the hardships, section 45A is inserted in the statute book. In short, it relates to only the individual and Hindu undivided family. It do not relate to companies, association of persons, partnership firms. So where the capital gain arises to individuals and Hindu undivided family from transfer of a capital asset, being land or building or both, under a specified agreement. That is, the specified agreement is the joint development agreement. The capital gain shall be chargeable to income tax as income of the previous year in which the certificate of completion of the project for whole or part of the project is issued by the competent authority. the stamp duty value on the date of issue of such certificate by the competent authority of the share of the landowner as increased by the consideration received in cash shall be deemed to be the full value of consideration. At the time of entering the joint development agreement, most of the time or many a times, cash is parted by the developer, certain amount of cash, whether by, it is not particularly cash, it is whether by way of check or demand draft or anything, or by way of RTGS or not, whatever mode of payment is there, that is not material, along with the full value, stamp duty value of the constructed part that was to be received by the landowner. That is the full value of consideration for the purposes of section 48. So far as valuation is concerned, this hardship has been removed, and this has made static that this is the full value of consideration. Proviso is there. Proviso says that if the landowner parts with his constructed area before the issue of said certificate, completion certificate, then again this provision would not apply. So certain things are there that this provision will not apply where the joint development agreement is not registered. It does not apply to companies, partnership firm, AOP, etc. Again, it is not applicable where the SSE, where the landowner parts with his constructed area before the completion certificate. So in these three circumstances, this provision would not be applicable. Now I am only touching the subject. The issue arises where I am putting the issue that whether section 45A would apply where the joint development agreement is based on revenue sharing basis. So in that circumstances, what is the full value of consideration? No constructed area is there. The second issue, whether section 45A would apply where landowner retains the constructed premises for his personal use. Third issue, what is in my mind, that section 247(5) does not speak of deferment of tax liability. As per section 45(5)(a), the tax liability has been deferred to the year in which the completion certificate is given by the competent authority. So tax has to be paid by the SSE in that very year. Though for the purpose of computation of holding the asset, then it is the date of agreement which is relevant. That holding part, that holding time cannot be deferred. Say if assessment year 2017-18 joint development agreement is entered into and the completion certificate is given in assessment year 2018-19, then holding part, that index has to be applied till assessment year 2017-18. However, tax has to be paid by the SSE in assessment year 2018-19. So, insofar as section 45(5)(a) is concerned, I am not going in much detail. Jagdish Bhai is there and Jagdish Bhai will explain in detail everything. Certain things I am also wants to explain that along with the consideration, section liability under section 194 IC is also there. Where the consideration is not in kind, say that at the time of entering of the joint development agreement, certain cash has been paid by the developer, then tax has to be deducted at the rate of 10%. This liability is always there. Again, in relation to this real estate transaction, section 51 is there. Say that if SSC is going to entering into the transaction, certain advance is received, but the transaction did not materialize, then that advance has to be deducted from the cost or WDV, whatever it is. But if that is treated as income under section 56 to 10 to 9, then that is not to be deducted because that was already treated as income of the SSC under the head income from other sources. Section 50C is also there. Section 50C is saying that stamp, if the consideration received by the SSC is less than the stamp duty value, then stamp duty value has to be adopted as the full value of consideration. Again, the issue arises that whether section 50C applies to leasehold properties. On this aspect, there is, contrary decisions of Bombay High Court and Rajasthan High Court. So I would request Jagdish Bhai to say, to throw light on this. Similarly, section 15 is with respect to depreciable asset. It says that where the depreciable asset is sold by the SSC, then capital gain arising therefrom has to be treated as short-term capital gain. Again, issue arises as to whether deduction provisions section 54 to 54G are applicable. To my mind, yes, that is applicable. Section 15 doesn't change the nature of asset. If it is held by the SSC more than 24 months, then yes, these beneficiary provisions are to be applicable. Then works contract. For the purposes of works contract, the important aspect now, it is there because earlier under ICAI guidelines, two methods were prevailing: completed project method or percentage completion method. Now under the new guidelines, under ICD 3, only one method is applicable. That is percentage completion method. One more aspect I want to say in respect of Chennai properties. When the developers are there, then whether that is the capital, the profit arising therefrom from the project is chargeable to tax under the head business profit and gains from business or profession, or under the capital gain. This issue has been settled at rest by the Supreme Court in the case of Chennai properties. In this case, Supreme Court has relied upon 2-3 cases. Earlier Supreme Court cases, that is Karanpura Development, 44 ITR page 236 and SG Mercantile 83 ITR page 700, and now has arrived at a conclusion that where the object clause of the companies is with respect to constructing and selling or letting out of the properties, then it is to be chargeable to tax under the head profit and gains. Another important provision is section 23(5). In the case of Bansal Housing, CIT versus Bansal Housing, 389 ITR 373, Delhi High Court had held that section 22 and 23 are applicable to the SSCs who are engaged in the business of construction of house property and therefore liable to tax on ALV of unsold flats. Now section 23(5) has been inserted in the statute book giving this effect. So friend, there are so many provisions which have been many provisions have been inserted by Finance Act 2017. So one more section, conversion of capital asset into stock in trade and stock in trade into capital asset. So capital gain is a subject which is so vast. There are so many issues, but we are fortunate that we have with us Jagdish Bhai, who will tell us and solve our all issues. I hand over the mic to Jagdish Bhai, and thereafter we will revert back in question answer sessions. Jagdish Bhai, I am handing over the mic to Jagdish.
Thank you, ma'am. Thank you, madam. Before Jagdish Bhai starts his deliberation, I would just like to give a brief introduction of Jagdish Bhai to our viewers. Mr. Jagdish Punjabi is a practicing chartered accountant since 1989. He has been a rank holder in CA intermediate examinations. He has been a lecturer in taxation and accountancy for 17 long years. He was head of the Department of Accountancy at St. Andrews College of Commerce and Economics, Mumbai. He has contributed to several articles and items in the ITAT news published in the Journal of Bombay Chartered Accountants Society. He is also a member of various committees of Bombay Chartered Accountants Society and also a guest lecturer in National Academy of Direct Taxes, Nagpur, as well as Direct Tax Regional Training Institute, Mumbai. Friends, the topic of taxation on capital gains in real estate transactions is a very vast issue with live and ever interesting judicial views from point of view of all concerned professionals as well as stakeholders. The most contemporary issues, as pointed out by our chairperson, the joint state development, works contract, and this has great legal importance. Besides, there are issues regarding long-term, short-term capital gains, cost of acquisition, 50C, TDS, and other things. Madam has just taken us to the history of capital gains right from 1922 to the present date, 98 years, and also has dwelled upon various sections of the Income Tax Act which deal with capital gains. So now I hand over the mic to our keynote speaker, Jagdish Punjabi, who will be explaining the intricacies of capital gains to us. Thank you. Over to Jagdish Bhai.
Good morning to everybody. Madam Bansal, Vijay Keval Ramani, Arvind Shukla, other dignitaries present at the webinar. I am grateful to the organizers for having given me an opportunity to visit, or rather I would say revisit, the select issues arising in the context of capital gains with reference to transactions in immovable property. Thank you, madam, for laying a background that will help me go better and maybe perform better. Maybe because of the foundation that we are laying, the credit may go to me. That's all because of the foundation. The basics, madam has explained. She has also raised a couple of issues, but at the outset, let me clarify that considering the time frame which is available, we could have chosen a particular subsection. Because joint development agreement session, madam, we take for about 2.5 to 3 hours, whereas here we had 90 minutes. So what we have done is, and since this August audience is aware of the basic provisions, we have chosen select issues which arise in the course of day-to-day practice. Nevertheless, any particular issue which is there, raised by madam or otherwise, we shall take them up in the question and answer session. What we have done at the outset is selected a few issues where we will go threadbare and understand the intricacies as to what exactly is the issue. As we are aware, when I transfer a capital asset, there results either a long-term capital gain or a short-term capital gain, depending on whether the asset qualifies to be a short-term capital asset or a long-term capital asset. when I inherit an asset, what happens is I become the owner of the asset from the date when the erstwhile owner passed away, and I, as a successor thereto, receive the asset by way of succession. Similar is the position in the case of gift, where I do not pay any consideration for acquiring the asset, but I receive the asset by way of a gift from the erstwhile owner thereof, who has been kind enough to bestow me the gift. Similar could be the position in various other cases. Now we are told that, look here, if you have inherited an asset, you have been lucky enough, you sell the asset, you pay us capital gains. The question is, what is the amount of capital gains? Because I did not incur any cost for acquiring that asset. I have got it either by way of succession, under in an inheritance, or under a will, or by way of gift, or possibly maybe by way of partition of an HVO. So these are instances listed in what we have as section 49. Now we are told that, look here, you presume that the cost of the previous owner is your cost. You presume that the date on which the previous owner acquired the asset for a consideration, that is your date of acquisition, which means to decide whether the asset is short-term or long-term capital asset in my hands, I will tag on to my holding period, the period for which my predecessor held the asset. And if that earlier owner also had acquired it by way of a gift, I will go backward to till I reach a person who acquired it for a consideration. So I will go backward. I will borrow the holding period. I will also borrow the cost of acquisition. Now I have sold the asset. The question is, I have sold the asset within a period of 1 year from the date of its receipt. As Madam pointed out, that short-term capital asset is an asset which is held by me for a period of up to 36 months before the date of its transfer. However, qua immovable property, being land or building or both, there is a proviso inserted, which proviso says that, look here, if you have had this asset for a period of 24 months or more, then it shall qualify as a long-term capital asset. For holding period less than 24 months will qualify as a short-term capital asset. Now, when I sell a long-term capital asset, I get what is called as indexation. Now, when I look at the section dealing with indexation, which is section 48, which deals with computation of capital gains, it says that when you compute long-term capital gains, you get indexed cost of acquisition. As we said, the previous owner's cost will become my cost. Now, I index it. Index it how? Index it, the explanation 3, small Roman 3 to section 48 says that indexation has to be with reference to the first year in which the asset was held by the SSE. The first year in which asset was held by the SSE. Now, who's the SSE? I am the SSE, not the person from whom I inherited the asset. Therefore, if I take an example where in financial year 1-2, the previous owner acquired the asset. He has passed away, leaving behind the asset to me. And I became the owner of the asset in financial year 18-19. Therefore, for a period from financial year 1-2 till 18-19, from 18-19 I will get indexation, no doubt on that, because that is the year from which I am holding the asset. But the question arises, what happens to indexation for the period from financial year 1-2 till financial year 16-17? It's a good period of 16 years. You are taking his cost, you are taking his holding period, but when it comes to indexation, the language of the statute suggests that no, look here, you can't be doing this. The language says that you index it with reference to the year when you started holding the asset. Undoubtedly, I started holding the asset from financial year 17-18. Now, it is here where the courts have intervened, and they said Bombay High Court first decided the issue in the case of Manjula Shah. Bombay High Court said that no. When you are going to the previous owner for the purposes of cost, you are going to the previous owner for the purpose of holding period. How do you say that for indexation, we will ignore the period for which the asset was held by the previous owner? Therefore, Bombay High Court in Manjula Shah's case told us that no, read all the provisions harmoniously, look at the intent, and therefore go back to the date of acquisition of by the previous owner and compute your indexation with reference to that. Following the Bombay High Court in Manjula Shah, we had Delhi High Court in Arun Shumlu Trust, and then you have a host of high courts, whether it is Calcutta, Gujarat, Karnataka, Punjab, and Haryana. Even Advanced Authority of Ruling has followed Manjula Shah. Unfortunately for us, the SLP has been dismissed. So this issue has attained finality. So when it comes to indexation of an asset acquired by a mode mentioned in 49.1, I will ignore the pure simple language of 48, but I will go to the previous year since the earlier previous owner acquired the asset. So this was about the first issue. It is on this lines that I propose to deal with the rest of the issues. This was a warming up sort of a basic issue, I appreciate, but there will be other issues now which will take substantial time possible. We will try to cover as many as we can in the 90 minutes allotted to me. Undoubtedly, if in between you feel that either the session is not interesting or that it's time to break for lunch, you can always send a chat message and the session shall end after that. Now, we come to 50C. Madam did speak about 50C. What does 50C say? 50C tells me that when you transfer a capital asset, which is land or building or both, and the consideration, full value of consideration received or accruing as a result of transfer happens to be less than the stamp duty value of the asset transferred by you, then we shall adopt the stamp duty value for the purposes of computing capital gains, which means stamp duty value of the asset transferred, if it happens to be more than the agreement value, so to say, then the capital gains will be computed with reference to stamp duty value. And to use the language of section 48, the section 50C itself, it says that the stamp duty value shall, for the purposes of section 48, be regarded to be full value of consideration. Now, with this background, let's come to a specific issues. Now, the first point which arises is that there is a private limited company wherein husband and wife are the owners. The company has nothing but an immovable property. So, I along with my wife transfer the shares of a private limited company of which me along with my wife are the owners. The company does nothing. It is merely holding the immovable property. The buyer is buying the shares not because he is interested in the shares of the company. He is buying the shares because he is interested in the immovable property belonging to the company. Question arose whether 50C will apply to such a scenario. Because what are you doing? You are effectively transferring a property. But what is the substance? The form may be that, what is the form? The form is there is a transfer of shares. And what is the substance of the transaction? Substance of the transaction is that there is a transfer of an immovable property which is belonging to the company. The buyer is not interested in the shares. The seller is not interested in selling the shares, he holds the property. Therefore, issue arose whether 50C will apply to such a case or 50C will not apply to such a case. We have a Karnataka High Court decision in Boruka Engineering Industries to tell us that the AO is trying to lift the corporate veil. When AO invokes 50C in such a fact pattern, what he is doing is he is trying to lift the corporate veil and apply the provisions as if it were the SSC has transferred the land. The action of AO in this case, Boruka Engineering's case, was upheld by the CIT and the tribunal. However, when it came to the High Court reversed it. The High Court said, no. What is the language of 50C? The language of 50C is that there should be a transfer of a capital asset being land or building or both. Has the SSC transferred land or building or both? If your answer is no, 50C cannot apply. It is a deeming fiction. It has to be strictly construed. So this is as far as transfer of shares is concerned. Now, this was a lacuna in the law. People were doing this. In the past, properties have been acquired through the medium of companies for various different reasons. Maybe to save stamp duty, maybe to bypass the regulations of ULC. There were several reasons why assessees chose to take immovable properties, not in their individual names, but in the names of their own corporate entities. Now, this loophole has been plugged. Please be sure that now you have 50 CA. So when you transfer the shares, the valuation of the shares will be done presuming that if the stamp duty value of the asset is the value of the asset belonging to the company. So when you are going to do a valuation of the shares, this will get factored in. So this is no more available, but the reason why I picked up this issue is that there is litigation going on from earlier years, and in the older matters, this may be of use to the members. On the similar lines is having, of course, dealt with Karnataka High Court, it's not necessary, but since this decision was the earlier decision, I thought it would be appropriate to mention it. It's a Bombay Tribunal decision in the case of Irfan Abdul Qadir Fasdar in this case, which is again saying that 50C will not apply to indirect transfers. It will apply to a direct transfer of land or building or. Now we come to the issue which Madam also mentioned in her initial remarks. Is 50C applicable to land or building or both, or also to land rights in respect of land or building or. Now we had, Madam did point out that there is a controversy between Bombay High Court and Rajasthan High Court. Yes, there is a controversy between Bombay High Court and Rajasthan High Court, but I would point out some instances where Bombay High Court itself has possibly expressed a doubt. Now, what is the proposition? The proposition is that when does 50C apply? 50C applies when you transfer a capital asset. Yes, it is my capital asset, no doubt. But the next question is that capital asset should be land or building or. So the question arises that what is land and what is building? When I transfer not the land or building, but I transfer, but if I transfer the rights in land or building, will you tell me that the provisions of 50C will apply? What could be examples of what I'm talking? Example could be, let's presume that I have booked a under construction flat in a project 3 years back. The project is still not complete. Now with this COVID, etc., I see difficulty. I feel that the developer will not complete the project for another year or two. Therefore, what? Therefore, I choose to transfer my rights under the allotment letter. A flat has been allotted to me. There is no agreement as such, but there are allotment rights to me, and I am transferring those allotment rights today, fearing that the market may go down. I may find it difficult to sell. Today somebody wants it. Let me have the property. Now, when I transfer these rights, this is what I call it as booking rights, and I make a profit. Will 50C apply, assuming that the consideration for transfer happens to be less than the 50C value? Is the question which arose. Another example could be where I transfer development rights under a development agreement. I am not transferring ownership of the land. What I am transferring is only the rights, the development potential of the land. I'm separating it and I'm transferring it to somebody, and I'm saying, look here, you go ahead, and with this development potential, you please carry on the development. He is not the owner of the land. I am the owner of the land. The question is this transaction covered by the scope of 50C or not? I am a tenant of a premises. I am not the landlord. I am transferring tenancy rights. In Maharashtra, it's permissible to have a document of transfer of tenancy rights. I am transferring tenancy rights, but the consideration which I am receiving for transfer of tenancy rights is lower than the stamp duty value of the rights which I am transferring. Now, these tenancy rights cannot stand without land, but nevertheless, they are not land. So, when I say land or building or both, will it also cover rights in land or building or both? Now, an answer which immediately comes to mind is, what's the great thing in this? And why are we discussing so much? Because whole includes the part. It's a settled position that the whole includes the part. So if I have not transferred the whole land, but I have transferred part of the land, it's still a transfer of land. But as I said, 50C is a deeming fiction. It has to be strictly construed. Again, we have various provisions spread over the Act, wherein wherever they wanted to cover rights in land, they have specifically mentioned. If land always covered rights in land, where was the need for legislature to make a specific mention in section 27, in chapter 20A, in chapter 20C, and at various other places? These are only examples I'm giving, which are, which will be easily relatable to you. So therefore, the question is, will 50C apply to rights? The answer is, prima facie, it appears no. But let's go a little deeper into this aspect, because this is going to affect even 242A. Because if what I have transferred is not land or building or both, then the holding period will be 3 years to qualify as a long-term capital asset. And therefore, I will not be entitled to indexation benefits, number one. I will not be entitled to exemptions under various sections from 54, 54F, 54EC, etc. All of them apply to long-term capital gains. And as I said, 242A has been amended to state that holding period for immovable property being land or building or both is 24 months, whereas if what you are transferring is not land or building or both, then it will qualify for a holding period of 36 months to become a long-term capital asset. Now, here you have a couple of decisions of various tribunals. You have Ahmedabad Tribunal in Yasin Usa Gadir, and then you have Devendra Barot, again by the Ahmedabad bench of the tribunal, telling you that 50C will not apply where it is only the booking rights which have been transferred and not the land or building. But for me to transfer a building, the basic thing is the building must exist. If there is no building, what am I transferring? I am transferring not the building, but the rights in building. And my proposition that for an building to be transferred, building has to be in existence, also derives support from Section 5 of the Transfer of Property Act. On the same lines, you have Jaipur Tribunal telling you that when you transfer the leasehold rights in the property, 50C will not apply. Now, here was an assessee who was a lessee of the property. He was not the owner. He was not the lessor. He was only the lessee. What he did is he transferred the leasehold rights. The lessor continued to remain the same. What was happening is the leasehold rights, which were enjoyed by Tarachand Jain, he transferred it to somebody. The question arose about computation of capital gains. And when the AO looked at the computation, he said, hey, the stamp duty value is much more. Why should I not apply the stamp duty value and compute your capital gains? The SSC said, under which provision? He says 50C. The SSC said, look here, read. 50C says transfer of land or building or both. What I have transferred is neither land nor building nor both. But what I have transferred is only my leasehold interest in the land. And therefore, the Jaipur Tribunal agreed with the SSC and said, no, the Kashtakar rights on the land, which is similar to your leasehold rights, cannot be equated with ownership of land or building or both. The law does recognize difference between land or building or right in land or. Therefore, here they take cognizance of what I mentioned, that you have section 27, you have 20A, you have 20C, you have so many other places where the legislature has specifically made a distinction between rights in land or building and also
Jagdish, are you there? I think there's some problem in his connection. We are just trying to connect him. Please. Jagdish, your connection is out. प्रेमलता मैडम कमेंट दे दीजिए इनका ये
बेटर है, आवाज आई
मैडम जी। मैडम आप
आवाज आ रही है?
आपको आवाज आ रही है?
आ रही है, आवाज आ रही है।
हाँ, तो तब तक आप इस पे कुछ कमेंट दीजिए। जो बोले हैं, जो उनका कुछ कनेक्शन करा रहे हैं, उनका कुछ कनेक्शन का इश्यू है।
अच्छा अच्छा अच्छा, अभी मैं कर रही हूँ, 1 मिनट।
हाँ, ठीक है। Jagdish, can you hear us now?
Hello. Vijay, can I start from this thing?
Yes,
Other
start.
बोलो।
the PowerPoint may not be there, but I will continue. Yeah. So I'll start from the other gadget. You have another gadget of mine, bro. Okay.
can share the
जगदीश भाई
PPT
आवाज
overall.
आ रही है आपकी?
आ रही है? Okay, fine.
आ रही है.
Okay, fine.
और PPT को शेयर कर लेंगे बाद में.
PP will share later on.
Right. Sir.
Fine.
Okay.
Right. Yeah, I'll begin from where we stop.
Right.
50C
Now-
booking rights.
Yeah, we
and
had a
leasehold
decision.
property.
Yeah. So for leasehold property, we had the decision of Jaipur Tribunal telling us that it will not apply. Then we said, I think we came to Chiranjeev Rao Khanna. And did we get Chiranjeev Rao Khanna, or should I repeat that?
Yes. It's okay.
Yeah.
Comes.
Yeah. In the case of Chiranjeev Rao Khanna, Bombay Tribunal held that 50C will apply to transfer of development rights. However, the tribunal in its order absolutely did not deal with why it is saying that the transfer of development rights amounts to transfer of land or building or both. It went on to 47.5. It said the transfer of development rights is also a transfer. Undoubtedly, transfer of development rights is transfer. But the point is 50C will apply only if what I have transferred is land or building or both. You cannot say that to every transfer 50C applies. 50C will apply only to those specified assets. However, Chiranjeev Rao Khanna was followed by Arlet Rodrigues, Milton D'Souza, Arif Akhtar Hussain. Till that stage, we did not have High Court, we did not have anything. You also had Mumbai Tribunal decisions in Shakti Insulated Wires and Voltas Limited now, which is widely reported, telling you that 50C will not apply to development rights, following all that I earlier mentioned. Then you had Bombay Tribunal in Atul Puranik's case, taking a position that transfer of leasehold rights will not attract 50C. Against that decision of Bombay Tribunal in Atul Puranik, the department did not prefer an appeal to the High Court. Rightly or wrongly, department chose not to prefer an appeal to the High Court. In Greenfield, department went to the High Court and they followed Atul Puranik. They said that, look here, what is your grievance? They asked the revenue, what is your grievance? The court, the reply of the revenue to the court was that, look here, sir, tribunal has erred. It has followed Atul Puranik. So the court said, what is wrong if the tribunal followed Atul Puranik? Have you preferred an appeal against Atul Puranik? They said, no, we have not preferred an appeal. So the court said, then what is the problem? If tribunal has followed Atul Puranik, its earlier decision, then, and you did not come to the High Court, then in Greenfield, why are you coming to the High Court? So department's appeal was not admitted. Then came Heatex Products. Again, the court held that, look here, I am following Atul Puranik, I am following Greenfield, and therefore I am not admitting. Now there is a decision of Supreme Court in Satish Shah's case, where Supreme Court says that if the revenue has accepted the decision of the court on an issue and not challenged it in appeal, then a subsequent decision following such earlier decision against which there was no second appeal by the revenue cannot be challenged. So if even today some order is passed following Atul Puranik, revenue will not be able to challenge that order following the decision of the Supreme Court in Atul Boop's case. Now came the question of Cancast. Bombay High Court, in the case of Cancast Private Limited, all the citations, etc., will be in the PowerPoint, which will be given to you later. So I'm not, for paucity of time, I'm not quoting the citations every time. I'll just give you the name of the decision. The Bombay High Court in Cancast, however, has admitted the substantial question of law. They said that, look here, in Atul Puranik, you did not prefer an second appeal. In Greenfield, it was not admitted on the ground that the tribunal in Greenfield followed Atul Puranik. There was a decision of Heatex also. But all this time, nobody pointed out the decision of Pradeep Steel Re-Rolling Mills. Now, Pradeep Steel Re-Rolling Mills is a decision where Bombay High Court has admitted the appeal on the substantial question of law. Therefore, we must be slightly careful now when we advise our clients that 50C will not apply to transfer of rights in land or bidding or both. Then came another case of Keki Bomi Dadi said before Bombay High Court. Now here, the AO saw that 50C value was much more than the agreement value, and the SSC had filed his return on the basis of 50, not on the basis of 50C value, but on the basis of the agreement value. So the AO issued a notice under 147 and started reassessment proceedings. Now the SSC came up in appeal to the High Court challenging the 147 notice which was issued by the AO. The High Court dismissed the writ on the ground that has AO anywhere said that because of Atul Puranik, he is issuing you a reassessment notice? The SSC said no, he is on first principles. The tribunal said then we are not striking down the notice stands, which again is a indication to us that there is probably a second thought going on. Then you have the decision of Rajasthan High Court in Ramji Lal Mina's case, to which Madam made a reference. It said that no, we do not agree with the decision of the Bombay High Court in Greenfield. Of course, Rajasthan High Court was not pointed out these other two decisions which I just mentioned, Cancast and Keki Bomi, nor was Pradeep C. re-rolling mills pointed out to Rajasthan High Court. Rajasthan High Court was only on Greenfield. They said no, in Greenfield, firstly they said if we accept this, then most of the cases will be outside the purview of 50C. I would respectfully submit that is no reason to hold that 50C will apply. Just because most of the cases are getting out based on the language of the section, then you amend the language, you amend the law, and you amend the language and amend the law, and you provide for it that everything will attract 50C. As long as that is not done, according to me, it was not for the court to say that since most of the cases will go out, 50C applies. I mean, that reason is not acceptable. Then you have another reason being given. They say, no, from the High Court order, we do not know whether what was transferred by the SSC was land or was held as capital asset or no. So High Court order does not mention that the SSC had transferred land held as capital asset or as stock in trade. Now, obviously, when you come to a High Court, the tribunal, the lower authorities would have certainly examined whether the land or the asset transferred is reflected as capital asset or is not reflected as capital asset. Anyway, be that as it may, that is Rajasthan High Court. Now I come to an interesting decision of the Bombay High Court. Now, if you will recall, there is a Finance Act of 1983. Under Finance Act of 1983, Section 40 levied wealth tax. It levied wealth tax on a closely held company. Now, the charge was inter alia on one of the items which read land other than agricultural land. It was land other than agricultural land on which wealth tax was to be paid. The SSC in this case owned huge land in Pune, which was in MIDC, but it was a leasehold land. The SSC did not offer that land for taxation in the return of net worth file, on the ground that what is taxable is land other than agricultural land. What I have is not land. What I have is only interest in land. I am only a lessee of the land. The matter traveled to the Bombay High Court, and the Bombay High Court said nothing doing. The expression land will include any interest in land. Therefore, Jai Hind Siaki is an authority for the proposition that the word land includes leasehold interest in land. Now, if I take this analogy further, development rights also 50C will apply, tenancy rights, booking rights, everywhere 50C should apply. Therefore, the reason why I am pointing out this as an issue and why I took some time on this issue is because we are under a impression that 50C does not apply to such transactions. So now at least whatever has happened. Going forward, we should be a bit more careful before we plan something on these lines. With this, now I come to a small issue on section 242A. Now, clause 42 capital A of section 2 defines short-term capital asset. As I have mentioned, the question is, when does an asset become long-term? The general rule is, if I have held the asset for not more than 36 months, then it is a short-term capital asset. If I have held it for 36 months or more, it is a long-term capital asset. The proviso has been amended, and the amendment says that if what you have transferred is an immovable property, being land or building or both, then the 36 months should be read as 24 months. Therefore, the question arises that when I transfer rights in land or building or both, will a holding period of 24 months apply, or will the holding period of 36 months apply? Now, the answer to this, one way could be that, sir, what is the meaning of the word being? Immovable property being land or building or both. Therefore, what follows being? There could be two views. One is that the being means namely. Therefore, what is appearing after being is only illustrative. Therefore, other things also can be covered. Because the word immovable property is very wide, unlike the word language used in 50C. Therefore, one is that, will I say that the word being means namely, and therefore what follows being are only, illustrations. So, namely, such as something like that. The other view is that no, the word being is exhaustive. It means that what follows is only to be covered. What does not follow the word being is not to be covered. Now, you have decisions for both the propositions. You have Madhya Pradesh High Court in Sri Synthetics telling you, for the purposes of 35D, that the word being means such as. Therefore, what follows is only illustrative. However, for the purposes of 242A, my suggestion would be that one should take a conservative view, and where it is only the rights in land or building which are transferred, there one should take a view that 242A will, the holding period to qualify as a long-term capital asset will be 36 months and will not be 24 months. Another issue is that you are saying land or building or both. What happens if I do not own land or building or both, but I own part of a building? Now understand, bungalow is a building, but a flat is not a building. A flat is part of a building. So when you say that there is a transfer of a flat in a society, a flat in a building, will it get covered by the word building? Because part of a building is not mentioned, is the argument. So I say whole includes part. Is it not that? Is the proposition not true that whole includes part? Therefore, whole building will also mean a part of a building, which is a flat. However, we have an amendment to the law very recently in, I think, AY 1314, where 194 IA was introduced. Now, 194 IA interestingly defines immovable property as immovable property being land or building or part of a building or both. Now, if part of a building was always covered by building, why does 194 IA make a specific reference to part of a building? Come to section 27. It is making a specific reference to part of a building. Now, if whole always included part, building was good enough to cover not only the bungalow or the entire building, but even a single flat in the building, then why does legislature choose as late as in 2013 to make a mention of part of a building in the provisions of 194 IA is something which one will have to consider. However, the assessee will be really worse off if he is trying to argue that for the purpose of 50C, 50C does not apply to rights. And the same assessee, when it comes to 242A, is taking up the position that no, rights in land or building are also covered by the phrase land or building. Now, another small point to be noted is that while the holding period has changed from 3 years to 2 years, there is no corresponding amendment in section 54 and 54F. Now, what does 54 tell you? 54 tells you that if you sell a residential house, which was your long-term capital asset, and the income of such house was chargeable under the head income from house property, then the long-term capital gain arising on transfer of such residential house will be exempt if you invest the capital gain in a new residential house. If you go and purchase or you construct a new residential house within a specified period. However, 54 also mentions that the new residential house should be held by you for a period of 3 years.
3 years.
Now, earlier, 3 years mentioned in 242A coincided with 3 years mentioned in 54 and in 54F for holding the new asset. If you do not hold the new asset for 3 years, what happens is stated in 54. That also is an issue to be considered, but for want of time, I am not dealing with that particular issue because that would again take a good 10 to 15 minutes time, and I have other issues to deal with also. Therefore, now for qualifying as long term, the holding period will be 2 years. But if you have purchased a new house by availing an exemption under 54, and such new house is transferred by you after say 27 months, then the provisions of 54 will get attracted. However, the gain will still qualify. The asset, the new house transferred, will still qualify to be a long-term capital asset because that definition is amended, but this 54 and 54F are not amended. So this is as far as 242A is concerned. There are other issues in 242A, but we need not bother about them at this stage. We now come to applicability of 50C to transactions covered by 45.3. Now, what does 45.3 say? 45.3 says that if you transfer your capital asset to a partnership firm or an association of persons or a body of individuals where you already are a partner or you are going to become a partner. So, I repeat that I am owner of an asset. I am transferring this asset to a partnership firm. I am introducing it in the partnership firm and saying that now on, this asset is an asset of the firm. Fine. They are saying that we shall regard the amount credited to your capital account in the books of the firm to be the full value of consideration. So, when I introduce an asset in the firm, whatever amount the firm credits to my capital account, the firm is going to pass an entry asset account debit to capital account of that partner. So, whatever is the value by which the partner's capital account is credited as a result of transfer of the asset, that shall become the full value of consideration. Now, consider an example where I own land which is worth, which I transfer it to a partnership firm where I am a partner, and the firm credits to my capital account an amount of 25 lakh of rupees. Therefore, 45.3 tells me that, hey, compute your capital gains by taking full value of consideration to be 25 lakh of rupees, which is the amount for which you have, which has been credited to your account. Now, since this is land, the AO in the course of assessment asked me that, sir, what is the stamp duty value of this land? And he finds out that the stamp duty value of the land is 1 crore. Now he says that I will apply 50C. Why should I not apply 50C? Why do you want to apply 50C? He says, look here, you have transferred a capital asset and the consideration is lower than the stamp duty value. Your consideration is 25 lakh and 50C says that whenever consideration is lower than the stamp duty value, I shall adopt stamp duty value. I say, no. 45.3 is squarely applicable, therefore do not go to 50C. So a question arises that what is this? In such kind of a situation, will both apply, or will 45.3 apply, or will 50C apply? Is it a case of fiction on fiction? 45.3 is one fiction. It is artificially assuming, it is artificially telling me that regard the amount credited in the books of the firm to be the full value of consideration. 50C is another fiction which says that where your consideration received or accruing is less than the stamp duty value, then adopt stamp duty value. I would believe that 45.3 deals with one set of transactions. 50C deals with another set of transactions. And if these two sets of transactions are represented by two circles mathematically, then the intersection where 50C also applies and 45.3 also applies is what we are discussing right now. So basically we are talking of a situation where I have introduced, and what I have introduced happens to be my capital asset, and it happens to be land or building or both. Now you had a decision of, now let me take a minute and explain that 50C up to 1st October 2009 did not apply where the agreement for transfer was not stamped or was not registered. Therefore, if there was a transfer without the agreement being stamped, 50C would not apply because the word assessable was not there. The language was adopted or assessed. So if I have not paid stamp duty, there is no question of the stamp authority adopting or assessing me. Then on 1st October 2009, effective 1st October 2009, came an amendment which added the word assessable. Therefore, now, even though the document of transfer, the instrument of transfer may not be assessed to stamp duty, no stamp duty value would have been adopted for that purpose, yet if it was assessable, the provisions of 50C are attractive. Now, in the Lucknow tribunal, in the case of Carlton Hotels, was dealing with a situation prior to the amendment. There somehow the tribunal took the view that, hey, look here, in this case, 50C does not apply. Why it does not apply? Because they said we do not have a registered agreement, Carlton Hotel Tribunal says. But they made a statement which was not required, and therefore I would feel it is an obiter. They said 45.3 is a general provision and 50C is a special provision. Now you were not required to make this comment. Your case was, the case before you was for a period prior to 1/10/2009. You said that because up to 1/10/2009, either the document has to be registered for the purpose of applying 50C. 50C is not applicable, and you should have stopped at that. But tribunal created a confusion by adding the sentence there that 45.3 is a general provision and 50C is a special provision which will override 45.3. That's a exact sentence from the decision. Now, this position prevailed, and every officer, left, right, and center, adopts Carlton Hotel. Now, let us therefore understand what is correct position. For 50C to apply, there has to be consideration. You cannot say 50C will apply when there is no consideration at all. Say, for example, I gift away my flat to you. Will you still say 50C is applicable? The answer has to be no. Madam made a reference to BC Srinivasa Shetty that the charging provision will apply only if there is a computation mechanism. Now, what is your computation mechanism in 50C? Your computation mechanism is that compare the agreement value with the stamp duty value. Therefore, there has to be two values. I will compare, and on a comparison, I will come to a conclusion that agreement value is less than the stamp duty value, and therefore I must take the stamp duty value and I must go ahead. Now, when a partner introduces an asset into a partnership firm, is there a transfer? The answer is undoubtedly yes. Sunil Siddharth Bhai, Supreme Court in Sunil Siddharth Bhai categorically tells us that yes, when a partner introduces an asset into a partnership firm, there is a transfer. But in the case of Sunil Siddharth Bhai, the assessee did not pay tax. So the question arose, is capital gain chargeable? So Supreme Court examined, is this asset capital asset? Supreme Court said yes. Is there a transfer? They said yes. Then they came to a question, what is full value of consideration? The department said the amount credited to the capital account of the partner is full value of consideration. Supreme Court said, no, hey, wait, that is not consideration. When a person joins a partnership, what is it when a person introduces an asset into a partnership in consideration of his being made a partner? What is the consideration? Why does he become a partner? They said he becomes a partner for two reasons. Number one, he gets a share in the profits of the firm. So as long as there is a profit in the firm, I will be always entitled to some share in the profit of the firm. And second, when the firm is dissolved, I will have an interest in the assets of the firm. Till the time firm is not dissolved, I will have no interest whatsoever in the firm, firm's assets. But upon dissolution, I will be entitled to an interest in the assets of the firm. So Supreme Court said, now let us look at it. Is there consideration? The answer is, will the firm make profits or losses? It is future only which is going to tell us. Possible that the firm may make losses. The entire capital balance may be wiped out. Possible that the firm may lose all its assets, and on the date of dissolution, there may be nothing left to come to my share. Therefore, Supreme Court put it very nicely. They said consideration lies in the womb of the future. Consideration lies in the womb of the future is what Supreme Court says. Therefore, when a partner introduces, there is a transfer, yes, but there is no consideration. And therefore, Supreme Court said your computation mechanism fails. Once again, following B.C. Srinivasa Shetty, no capital gain to be charged. Legislature said, how can this happen? How can we allow all this to happen? It is because of this decision, because of these observations, that you have 45.3. 45.3 was amended, and they gave an answer to the Supreme Court that, look here, now on, you have full value of consideration. Don't tell me you do not have consideration. We are quantifying, we are creating a fiction. Now, Supreme Court in Moon Limited's company's case has told us that there can never be a fiction on fiction. So, first, 45.3 is a fiction. 50C is another fiction. Can you apply a fiction on fiction following Moon Limited? According to me, no. That's one argument. Second, come to first principles. I'm saying, where is the consideration? There's no consideration at all, and Supreme Court has told you that in so many words. It is only an artificial fiction, and that fiction was only to compute the capital gain arising to a partner. It's for that limited purpose that you have said that we will regard the amount credited to be the full value of consideration. It is actually not full value of consideration. Therefore, please do not apply 50C is my contention. Fortunately, Carlton Hotels Tribunal's decision has been overturned by Allahabad High Court. And SLP against the Allahabad High Court decision has been dismissed. Allahabad High Court said, we do not agree with the tribunal. On what ground? They said tribunal has ignored the basic argument of the revenue that in the facts of this case, the transfer was a sham right from inception. The assessing officer's level, it was said that the transfer is a sham. There was no reason, and the tribunal has not examined that aspect at all. Therefore, we are setting aside the order of the tribunal. So, the order of tribunal in Carlton Hotels stands set aside by the Allahabad High Court. SLP to the Supreme Court against the decision of the Allahabad High Court stands dismissed. And you have a decision of Bombay Tribunal in Amal Tara Private Limited, where they say that there cannot be a fiction on fiction. They go through the decision of Moon Limited and they say that 50C will not apply to a transaction of the nature covered by 45.3. Be mindful of the fact that there is an appeal in the High Court against the decision of Amal Tara Tribunal decision. However, last when I had examined it, the appeal was pending for removal of objection on the part of the revenue. I am not aware whether the objections have been removed by the revenue or not, and if there has been a delay, whether the court will condone the delay or will dismiss the appeal on that count. So, I mean, that time alone will tell us, but the decision has not been examined by the Bombay High Court. So, Amal Tara is a tribunal decision. Then Amal Tara has been followed by Calcutta Tribunal in Nirmalendu Singh's case, and also by the Mumbai Tribunal, of course, in Moti Ramanand Sagar's case. Mumbai Tribunal bound to follow because it's a coordinate bench decision, and Hyderabad Tribunal as well has followed Amal Tara. Therefore, you have series of tribunal decisions now telling you what to do. It tries to tax market value as against the agreement value. Did the legislature ever intend to tax market value in a case where SSE introduces a capital asset in the partnership firm? To my mind, no. Why do I say so? The very Finance Act 87, if I'm not mistaken, by which 45.3 was introduced, 45.4 was also introduced. So 45.3 and 45.4 introduced by the legislature simultaneously. 45.3 deals with admission of a person as a partner. 45.4 deals with dissolution of a firm. 45.3 talks of adopting book value, whereas 45.4 talks of adopting market value. If legislature wanted to tax market value at the time of introduction of the asset into a partnership firm, then when it said for 45.4 that market value should be adopted for 45.4, or 45.3 also it could have said market value. Nothing stopped the legislature from making that provision. However, legislature in its wisdom has chosen to tax me only on the book value when I introduce a capital asset into a partnership firm where I am a partner. And interestingly, you have an article in taxman.com on this very same issue in 2013, where a view opposite to Carlton Hotel has been taken. Exactly opposite of what Carlton Hotel. Now you may say, okay, what's so great if somebody in an article takes a view contrary to Carlton Hotel? Surprisingly or incidentally, the author of the article is the same member who was the author of the decision in the case of Carlton Hotels. So probably on a rethink, that very same member who wrote the order in Carlton Hotel felt that 50C will not apply, and therefore he wrote an article in 2013 on taxman.com taking up a view which was contrary to the decision pronounced by him while he was on bench in Carlton Hotels case. With this, we now come over to other issues on 50C. I do have about 30 minutes left. So let me first deal with 50C together with 54F. Now, when I sell a residential house and I make a long-term gain, capital gain, I'm entitled to exemption under 54 if, upon satisfaction of conditions mentioned in section 54, I purchase a new house or I construct a new house within the time frame mentioned in the section. 54 makes a reference of capital gain. I will undoubtedly compute capital gain by applying 50C, and the gain so computed possibly may have to be invested is one view. Another view could be no. To decide the exemption, I will compute gain the host for 50C. Therefore, I will not apply 50C. I will compute long-term capital gain, and then I will say, okay, this is the amount which I am required to invest. Therefore, what I'm in short telling you is that the difference between the stamp duty value and the agreement value need not be invested, is one of looking at this. But when you come to 54F, difficulty is slightly greater. In 54F, what happens is, if your 54F applies when you transferred a long-term capital asset other than a residential house. So if it is a residential house, you go to 54. Other than a residential house, you come to 54F. 54F also requires you to buy a new house within the period mentioned and subject to satisfaction of the conditions. We are not getting into those conditions at the moment. However, unlike 54, which requires me to invest capital gain in purchase of a new house, 54F requires that I must invest net consideration. 54F requires that I must invest net consideration. And the word net consideration has been defined in an explanation below 54F itself. And it says, since PowerPoint is not on the screen, I'm reading it out for you. Net consideration in relation to transfer of capital asset means full value of consideration received or accruing as a result of transfer of the capital asset, as reduced by expenditure incurred on transfer. Therefore, what is full value of consideration received or accruing as a result of transfer? Undoubtedly, it is the agreement value. Therefore, now consider an example. I sell a capital asset for 110 rupees. 10 rupees is my indexed cost of acquisition. Therefore, without applying 50C, the long-term capital gain is 100. However, when I go to pay stamp duty, I am told that the stamp duty value is not 110, but it is 1010. So now, after applying 50C, when I compute long-term capital gain, it is 1010 minus 10 rupees index cost. Therefore, 1000 rupees is the gain. If I do not apply 50C, 100 rupees is the gain. If I apply 50C, 1000 rupees is the gain. Now, I am required to invest net consideration. Now, what is net consideration? Is my net consideration 110 rupees or is my net consideration 1010 rupees? Going by the language of the explanation to 54F, I would find that it requires me to adopt full value of consideration received or accruing as a result of transfer. And what is received or accruing is only 110 and not 1010. However, there is a difficulty with this interpretation. The difficulty is that if you accept this interpretation, then the purpose of 50C stands defeated. I will sell an asset for 110 rupees, pocket 900 rupees cash, go and invest 110 rupees in the new asset, and then say, give me my entire capital gain to be exact. Now, what exactly is the purpose of 50C? The purpose of 50C is that, look here, we believe that there is a cash component in every transaction. And what is the correct benchmark? The correct benchmark, according to me, is stamp duty value of the property. So if you have sold something below stamp duty value of the property, I am presuming that you have received cash, and therefore indirectly I am taxing you capital gains on that. You may not have received it, but by a fiction of law, by virtue of the fiction created by 50C, I am telling you, you presume you have received not 110, but you presume what you have received 1010. However, rightly or wrongly, 50C uses the phrase for the purposes of 48. Therefore, the argument is, it is only for the purpose of 48 that you go and substitute the stamp duty value. It is not for the purpose of 54F. So when you are reading 54F, why are you substituting the 50C value? 50C value, the fiction itself tells you that, look here, I am created only for the purpose of 48. So why are you applying me to 54F is the argument possible. This is one. Another argument is, look here, you may assume what you want for the purpose of taxing me, but the fact of life remains that I have received only 110. How do you expect me to go and invest 1010 rupees? Where am I going to get 1010 rupees from? Therefore, there is impossibility of performance. You have nothing on record to prove that I received a single rupee more than 110 rupees. Maybe I sold it in an auction. Maybe I was in distress. I wanted money. maybe I was a fool. I mean, nobody educated me that the value of your asset is 1,010, not 110. For right reasons or wrong, I did transfer it for 110. Therefore, how do you expect me to perform the impossible by investing? The argument against me is, hey, look here, if I accept your argument, then what happens? Then for the purpose of 54, if the person wants a benefit, he has to invest 1,000 rupees. Your 54 requires capital gain to be invested. But for the purpose of 54F, if the person wants 100% capital gain to be exempted, then what will happen? Then he has to go and invest only 110 rupees, because 54F says invest net consideration, and you are trying to argue that net consideration is only 110 rupees and not 1,010 rupees. Now, Jaipur Tribunal in Kansan Batra's case first dealt with this situation. They said that 54F has to be read independently. When I am reading 54F, I will not read 50C into it. Your 50C very clearly says that I have to apply, I am applicable only for the purposes of 48 and not for any other purpose. Jansen Batra went on for some time. There was some Bombay tribunal judgment, etc. Then came Bangalore tribunal in Gauli Mahadevappa's case. Now, in Gauli Mahadevappa's case, a person received 20 lakh, but he went and invested 24 lakh. But the stamp duty value of the property was much more than 20 lakh. So, A, understand, he invested 20, he sold it for 20, 4 lakh he brought it from somewhere else, and he purchased a new house for 24 lakh. But the capital gain was, the stamp duty value was much more than 24 also. The SSC said, look here, I've invested more than even what I received, so give me 100% gain as exempt. The tribunal said, no, wait. Where do you get this? You have computed, you are required to compute capital gain by applying 50C. SSC said, fair enough. I will compute, and I have computed capital gain by applying 50C. But my entire capital gain gets exempted because I have invested net consideration, or rather 4 lakh more than net consideration for purchase of a house. The argument did not gel with Bangalore tribunal in Gauli Mahadevappa's case. They said, no, let us look at it. What is the object of 50C? The object of 50C is to catch hold of flats. And if we allow this kind of exemption, then what happens? Then they say the purpose of 50C gets defeated. Therefore, what? Therefore, tribunal came up with a brilliant interpretation. They said, look here, the difference between stamp duty value and the agreement value is something which by a fiction is regarded as consideration. Therefore, this is not consideration at all. Therefore, this is some other gain, not a gain arising from transfer of the asset. Therefore, qua this gain, you will never get exemption under 54. Therefore, what Bangalore tribunal in Gauli Mahadevappa said case tried to tell me is that qua the extra, qua the difference between the stamp duty value and the agreement value, I will not be entitled to exemption under 54F. Why? Because this is something akin to my unaccounted income, and qua something akin to your unaccounted income, you cannot get exemption under 54 or 54F. I mean, that was what appears to be the ratio, and they said the exemption will be restricted to 20 lakh. Though SSC had invested 24 lakh, they said exemption will be with reference to 20 lakh and not to 24 lakh. This decision of Bangalore tribunal traveled to the Karnataka High Court, and there the court held if you read the decision of the High Court, the questions, substantial questions of law which have been referred by the tribunal to the High Court are excellently framed. Had the High Court answered those questions in a narrative form clearly, it would have left no doubt. However, for whatever reasons best known, the tribunal or the High Court also went by the object, and they said, look here, if we take the interpretation that don't bring in 50C for the purposes of 54F net consideration, then the entire object gets defeated. Therefore, what? Therefore, they say, for the purpose of, where do you get full value of consideration? You get it in 48. Computation mechanism is in 48. 50C tells you that for 48, treat me as the full value of consideration. So therefore, for 54F also, that becomes your full value of consideration. Therefore, in short, Karnataka High Court said that the SSC will have to invest the entire stamp duty value, though not stated in so many words that the extra you will not get, or rather you will get an exemption under 54F. They have, in that case, said that yes, in the facts of our case, SSC will be entitled to exemption with reference to 24 lakh and not with reference to 20 lakh. Therefore, the position after High Court decision in Gauri Mahadevappa appears to be that the difference between stamp duty value and net full value of consideration received or accruing as per document of transfer also will qualify for exemption under 54F. And what you have to invest is not the agreement, the consideration as per transfer document, but the consideration adopted, or I mean for the purposes of levy of stamp duty, or the 50C value has to be adopted. Now this decision of Karnataka High Court has been followed by Hyderabad Tribunal as well. Now this is 50C with reference to 54F. Now can we say that the position for 54 is very clear, that I definitely need to invest the capital gain amount computed after applying 50C, or can I say that for the purposes of computing how much capital gain I have to invest, I will make a computation under 54 which will be different from my computation for the purposes of 45. According to me, this argument is not valid. Now, the case came up before the Bombay High Court in the case of Jagdish Dhabalia, where it was in the context of 54EC that the issue arose. 54EC also requires investment of only the gain portion. It does not require investment of the net consideration. Now, even for the gain portion, the SLC took up an argument that, look here, I have invested all that I received. Now, you are expecting me to perform the impossible. How can you expect me to invest the entire thing? The court said, nothing doing. The Bombay High Court said, if we accept this interpretation, it defeats the object for which the section has been introduced, and such an interpretation will render the provisions of 50C redundant. We cannot adopt any interpretation which renders a particular provision of the statute redundant. Therefore, that's as far as 54EC, Bombay High Court. Now, therefore, you have on the one hand Karnataka High Court for the purpose of 54F, you have Bombay High Court for the purposes of 54EC, and similar analogy would apply to 54 as well. Therefore, by and large, the position appears to be that you will have to compute your capital gain to decide the amount to be invested after applying 50C, and also while investing the consideration for the purpose of 54F, the net consideration will have to be computed with reference to stamp duty value if that happens to be greater than the agreement value, so to say. So that is as far as 50C with reference to 54 and 54F. Now let us deal with one or two issues. I have about 15 minutes left with me. So let me deal with one or two issues qua 54. Now, section 54, as I mentioned earlier, gives me an exemption subject to satisfaction of conditions mentioned in the section if I go and purchase or construct a residential house. If I go and purchase or construct a residential house within the time period mentioned in section 54. Now, effective assessment year 15-16, the word a has been replaced by 1. Therefore, earlier, that is up to assessment year 14-15, people were arguing, and there are decisions of the courts to the effect that a does not mean an indefinite, does not mean one or singular. A is an indefinite article. Therefore, I could have invested the gain arising on sale of one house into more than one house. So if there was a father living with two sons in a house, the sons were not getting along well or the families were expanding, the father could always sell the house and purchase two separate houses where two separate children would reside with their respective families, and the father would not be chargeable to any capital gains. However, effective assessment year 15-16, because of this controversy, legislature said that, hey, we don't want all this argument. Therefore, we replace a by 1. Therefore, what is the position now? The position is that you can go and buy only one residential house. Very good. So what you're telling me is that I must invest one house and I must buy one house. I asked myself two questions. A, can I sell 3 houses and go and buy one house? Have you stopped one to many, or have you also stopped many to one? Another question which arises is that can I sell 2 houses and go and buy 2 houses, subject to, of course, the time limit, etc., being satisfied? The answer. So therefore, what I'm saying is the officers feel that no, 54 gives you exemption for one house. Is it exemption for one house, or is it that you take gains of as many houses as you have in a year maybe and invest it in one house, or qua each household you go and purchase another house? Which is the correct interpretation? Am I getting the question? Many a times what will happen is that I have a time period of constructing the house. I have a time period of constructing the house within 3 years. But when it comes to purchase, I can purchase a house 1 year before transfer or 2 years after transfer. So consider a case where I am selling a house in year 1. Now this gain I have to use in purchase or construction within a period of 3 years. I choose to construct a house and I construct it within 3 years. So from year 1, when I construct it in 3 years, I come to year 3, let me say, right? In year 3, my construction was over. So condition satisfied, that gain I will get. Now I sell in year 4 some other house, not this new house, some other house, and a gain arises, right? Can I tell the officer, hey, look here, I have purchased a house 1 year before. Or instead of construction, you take it as purchase. The earlier house I had purchased within 2 years. So from year 1, I came to year 3. In year 5 or year 4, again I sell another house. The officer tells me pay long-term capital gain. I tell him, hey, wait, there is an unutilized capital gain for the house which I have purchased in year 3. And that house has been purchased within a period of 1 year before the date of transfer. Therefore, I am not going to pay tax on this at all as well. Am I clear on the question? The purchase price of my house was far greater than the capital gain of arising to me in year 1. So that unutilized purchase price I am trying to utilize in year number 4 when I sell some other house. Instead of buying another house, I am telling him that look here, your section says that go and buy house 1 year before the date of transfer. 1 year before the date of transfer, I have purchased a house, and for that house, I have unutilized capital gain. When you look at the purchase price versus the exemption which I have claimed. Now, such are the issues which arise in day-to-day practice. Now, we have a Mumbai tribunal decision in the case of Bipin Sagar. Now, what happened in Bipin Sagar's case is that the man was residing in a house which consists of 3 separate flats which were combined by him. So, on a particular floor of a building in Bombay, there were 3 flats. This man owned all the 3 flats, and he had converted all 3 into one big house. It was admittedly one house, but when he purchased, there were 3 residential flats purchased. So there were 3 agreements. Now, because there were 3 agreements, there were 3 share certificates in the society. And when he sold also, he sold it as 3. Cost of 3 was known to him separately. Selling price of 3 was known to him separately. He worked out long-term capital gain for each of the 3 houses. What he did was he went to a better locality and purchased one new house. So the officer says that, look here, what have you done? You have purchased one house, but you have sold 3 houses. So I will give you exemption only with reference to one. Though not stated, what the officer had in mind was that he wants that for every house purchased, sold, and gain made, the assessee should have purchased another house. So maybe the officer wanted that you go and purchase 3 houses. Or maybe the officer wanted that no, 54 will give you exemption only once. If you tell me only once, I will ask you once in what? Once every year? Once in my lifetime? When? When you say once, what do you mean by once? It's not stated in the section. Anyway, whatever it was, the AO said, I'm not giving you an exemption qua 2 houses. Qua 2 houses, you pay the tax. When the matter came up before CIT appeal, the assessee argued that, look here, AO had no difficulty if it was one house. The CIT appeal says, yes, he had no difficulty if it was one house. So we said it was only one house. There may be 3 independent residential units, but it was one house because it was combined. It had only one kitchen. The photographs were shown, and a Bombay High Court decision in the case of Devdas Nayak was pointed out, and it was said that, look here, the Bombay High Court in that case has said that it may not be possible for an assessee to find a bigger house, and that may require him to combine 2 or more adjoining units. Those units may be independent residential units, but when combined, they constitute one residential house. And many a times flats are constructed in a manner that they can be easily combined and one big house made. Now that becomes convenient also if family at a future date requires separation, the walls can be built and that house can become, one house can become 3 houses. Allahabad High Court in Shiv Narayan Chaudhary's case has said that self-contained dwelling units which are contiguous, which means adjacent, and situated in the same compound and within a common boundary having unity of structure could be regarded as one house. Now following this, we said, look here, it was only one house. You look at, take a certificate of from the society that how many people were staying there. Was it 3 houses or was it one house? The society will tell you it is one house. We have given you photographs that it was one house. So the CIT appeal said, yes, this is a case of one house, number 1. But he did not stop there. He also relied on 2 Mumbai tribunal decisions, which said, one was the case of Ranjit Vithaldas in 137 ITD 267, where more than one houses were sold and one house was purchased. So assuming that these were three separate houses, the argument was 3-1 is also allowed. What is stopping you? What was the case before Ranjit Vittal Das? In case of Ranjit Vittal Das, the SSE was 25% owner in two houses. Two houses totally located in totally different buildings, in totally different geographical locations. In 1 year, he sold one house, went and purchased a house. One house was sold. I said SSE was only 25% owner of the house. The other three brothers were holding the balance 75%. So there were two family houses where four brothers were owning jointly. They sold these houses and the brothers went out separately. Now, in year one, house was sold. The SSE share was 25%. He went and purchased another house. Subsequently, in year three, again, second house was sold where SSE share was 25%. Capital gain occurred. SSE said, look here, 1 year before I have purchased a house, there's unutilized capital gain. For that same thing, I want to use it. So this is exactly same as the example which I took at the beginning, that I am selling multiple houses in multiple years, but buying only one house, but the purchase or construction is so placed that it satisfies the time frame conditions given in section 54. The matter came to the tribunal. The AO obviously did not allow it. The matter came to the tribunal, and the tribunal said there is no restriction that capital gain arising from sale of more than one residential house cannot be invested in one residential house. A categorical finding by Mumbai tribunal in Ranjit Vittal Das. They go ahead and say even if two flats are sold in 2 different years and capital gain of both the flats is invested in one house, exemption will be available in case of sale of each flat, provided of course the time limit of construction or purchase of the new house is fulfilled in case of each flat sold. So you have Bombay Tribunal in Ranjit Vittal Das categorically telling you, and to my mind correctly, because wherever legislature wanted something to be restricted to one, it has said so. Say for example, you go to back to section 23, it talks of one residential house to be selected. 23.4 makes a reference to 23.2, which is self-occupied property, and says that when SSE has more than one self-occupied property, he has to choose any one. Therefore, they are identifying where they want one, they have specifically made a reference. Then you also have a decision of Mumbai Tribunal in Rajesh Keshav Pillai's case, where again the SSE owned 2 flats. He went and sold 2 flats and he purchased 1 flat. The tribunal in Rajesh Pillai's case said that wherever exemption is to be restricted to one asset, a suitable provision is incorporated in the section itself. They said, for instance, you have 23.2 exempts income from property where SSE is owner or part owner of the property, and 23.4 makes a reference to it. They said there is no such provision in 54 to restrict exemption to sale of only one residential house. Therefore, they concluded that the SSE can get 54 benefit for any number of units as long as he satisfies the conditions mentioned in section 54. Now, therefore,
so we have got time constraints, sir. So,
yeah, so just I'll wind up on this issue, sir.
Right.
So therefore, when it comes to many to one or many to one, it is allowed. There is no prohibition in either 54 or 54F restricting you to, confine your claim for exemption only qua one house. Now, very recently, you have a decision of Ahmedabad Tribunal in Muhammad Hanif Sultan Ali, where SSE sold land and he went and purchased 2 adjoining bungalows. He purchased 2 adjoining bungalows and he said, this is one house. There may be 2 bungalows, so what? But this is one house, and the tribunal, even after the amendment made in assessment year, effective assessment year 15-16, introducing the word one instead of a, has held that the assessee will qualify for exemption, because they said a larger house was required. So what if he has purchased 2 bungalows? The 2 bungalows are being used as one residential house. So you can rely on this decision. This decision is for a period post amendment made effective assessment year 15-16. I mean, we can go on and on, but in the interest of time, we pause here and we may take up questions depending on what the organizers decide. Thank you.
Thank you, sir. Thank you very much for this nice and lucid deliberation. Sir, the subject is so vast and with the changing and amendments and case laws that we can go on and for days on this subject. And in fact, there are certain issues of capital gains which could not be touched due to the time constraint, and we hope to have a session once again. Sir, there are certain questions which are there directly in the chat box. So, sir, would you like to see your chat box yourself, or should I read out for you?
I would prefer you read out the question.
Okay. I'll start from the last. Doctor's case claiming 54F not allowed. Reasoning: residential house will be used also for clinic based on statement of architect behind the assessee.
Sorry, I did not get the. What is the question?
There is a doctor who is claiming 54F.
Yes.
But it is not allowed, with the reasoning that the new house will also be used for a commercial purpose as a clinic, and therefore it will not be allowed. 54F.
See, firstly, there are 2 or 3 dimensions to this question. One could be, I'm ignoring the interplay between section 50 and 50C. There is an interplay between 50 and 50C on which you have Bombay Tribunal special bench decision in the case of Marine, United Marine Agencies, right, which says that even qua the gain computed under section 50, 50C will apply if the gain is required to be computed under section 50. However, if the block continues, 50C will not apply, because when the block continues, you go to the provisions of section 43, you do not come to section 50. 43 is in the chapter business income, 50C cannot travel to business income. Now, the mere fact that I will use it as a clinic is no reason for the AO to deny the benefit. Of course, if the property being purchased is a commercial property, I would believe AO would be justified in not granting an exemption. But if the property being purchased is a residential house, whether I'm going to use it as a clinic or otherwise, 54F does not say that you should use the house for the purposes of your residence or for the residence of anybody else. Tomorrow you will start telling me that you come and stay in this house.
Okay. Next question.
Yeah.
The contingent of land to partnership firm by partner as a capital asset, but no amount treated as capital account. He has transferred the land to the partnership firm.
Yes.
The ply or not. There is a registered deed of partnership with the registrar of assurances as to capital contention of land. Partner only received against his share of future profit, but not transfer.
How can, if you admit that there is a transfer, if you admit that there is a transfer, hello.
Perhaps the queries wanted to say that it has not been registered in the name of the partnership firm, and he has.
Registration is a separate aspect. The tax provisions will apply, deholds the registration. 45(3) or 50C are not at all connected with registration. Now, his point is that I contributed the asset in the partnership firm, and I got a share in profit. Now, if it was a gift, then certainly it will not apply. What I would believe is that he ought to have made a gift. I mean, but if he has introduced it, in whose balance sheet is the asset being recorded? is it recorded in the hands?
In the,
so then, because that will decide if the partnership firm is recording the asset in its balance sheet, it would have recorded a second effect of that entry, no?
Right.
Because the partnership firm would have debited the asset account and would have credited his capital account. You are saying there is no credit to capital account. Credit would have gone somewhere, no?
Right. Correct.
Yeah.
Next question. If I invest in a house property by buying 25% ownership in my son's house, whether I get 54 exemption?
Undoubtedly, yes. There is no provision saying that. There is no provision which says that you cannot buy from your son. Also, when I buy part of a property, it is akin to a full property purchased. I may not have money to buy the full property. Therefore, I may buy a property jointly with some other person. 54 will be available. You have Gujarat High Court there.
Right.
I mean, I do not remember the citation at the moment.
Right. There's a question from Anil Kumar Gupta. Please consult that my SSC at the time during demonetization period deposited cash in current account rupees 10,50,000 and total cash deposit on 1/4/2016 to 31st March 17, including 10,50,000 is 3,65 lakhs and odd. Meanwhile, SSC filed the ITR, but wrongly filed ITR in form number 3, but the CPC declared invalid. He declared income at rupees 2,98,000.
Shuklaji, this is not relating to the topic. I think we can skip it. We can go to the next.
Next question. Okay. Whether 50C will override 45(3) with respect to transfer of property by registered sale deed by partnership firm having consideration much less than the value of stamp purposes.
It is.
Naveen Garg पूछ रहे हैं.
Sir, इसमें आपने अभी ये बताया.
Override 45(3).
The answer is 50C will not override 45(3) in view of the Bombay Tribunal decision in Amar Tara, which has been followed subsequently by other benches of the tribunal. But here in the question, आपने पढ़ते समय ये बोला partnership firm transfer कर रही है. तो partnership firm जब transfer करेगी, तब तो 45(3) आने का सवाल ही नहीं आता है. This is a reverse case which you are talking.
Compute capital gains. Right. How to compute capital gains in case new residential house is received against the surrender of tenancy rights?
If new house is received against, I understand. This is a case of consideration being received in kind. So what you will have to do is, on the date of transfer, there is some background noise. If you can. Hello.
There's nothing in this query. There's nothing in this query.
No. There's some background noise. If you can mute somebody.
Madam, I think, madam, there's something. मैडम प्रेमलता बंसल आपके ऑफिस में कुछ बात हो रही शायद.
नहीं मेरे ऑफिस में तो कोई है ही नहीं मेरे पास.
कोई है ही नहीं. अच्छा पता नहीं कहां से आवाज आ रही थी. Anyway.
Yeah. Now this is a case of consideration received in kind. The value of the house which you are receiving will be the consideration for surrender of tenancy rights as on the date of transfer. Now stamp duty value could be one indicator, but if AO can establish that the market value is more than stamp duty value, he may be justified in adopting the market value.
Okay. TDR
Sir, I have to differ with you if Shukla ji allow me to speak.
Yeah, please, madam, definitely. Yes.
Shukla ji, I am differing with the opinion of Jagdish bhai, because surrender of tenancy right, tenancy right is less than land itself, because land have so many rights and tenancy right is lesser than the right in the land. So as and when you will sell the land or you will sell the tenancy right, then you will fetch the lesser amount than the, because in tenancy right you are not having the ownership. You are having the right in the land, but that is ownership is lacking in that. So to my mind, section 50C would not apply. It has not to be applied because
it's not about 50C, madam. It is not about 50C.
Because आपने जब 50C का discussion किया, then also you have told that leasehold property, I mean 50C would apply to leasehold property as
That's
well.
what Bombay High Court and Gujarat, Rajasthan High Court say.
But in that, Rajasthan and Bombay are differing in that, no?
No. Bombay
So,
subsequent ones which I pointed out. I am talking of decisions post Greenfield, talking of Cancast, and I am talking of Hite.
Yes,
Yeah.
Yes, you have explained, but in any case, Rajasthan is differing from Bombay, na? Because how stamp value consideration would be put in place of consideration of leasehold property?
No, even assuming that stamp value is not to be put, how would you answer the question? His question is, he gave up tenancy,
And
right?
if say what Shuklaji is saying, that the consideration received on surrender of tenancy right and the I mean the flat is received in place, that is in kind. So the full, I mean surrender of tenancy right is no doubt that is the long-term capital asset, right? If it is surrender, I mean tenancy right is held for more than 3 years, then of course it is a long-term capital asset. So that is one part, that long-term capital asset have been sold by the SSC. If the flat is received in place of it, then stamp duty value has to be taken, and the
That
difference between the two is the
correct. That is what I said, madam. The stamp duty, the market value of the flat received, and I said stamp duty value is the indicator of the market value. But if the AO can establish that market value is even more than stamp duty value, then going by Supreme Court decision, he will be entitled to substitute the market value, because the question is, consideration is value of what you receive, not what you give. When you say tenancy is a lower right, inferior right, tenancy, you're valuing tenancy. But I don't have to value tenancy going by Supreme Court. I have to value the house which is coming in.
Yes, of course.
So the question was on that.
Because I also wanted to discuss your opinion at the time of your discussion that 50C would apply to leasehold property as well. That is why I have discussed this, that 50C cannot be applied to
Very good if it does not apply. Very good if that is a...
50C shall apply whenever a registration is required. If registration is not required, then 50C will not apply.
Sir, ये condition कहाँ है 50C में? 50C, if there is a transfer, then registration is necessary under the transfer of property.
If a transaction, madam, if a transaction requires registration under the Registration Act or under the Stamp Act, then only 50C will apply, because even the word assessable will be applicable only if registration is compulsory. If registration is not compulsory, then what assessable will also not apply. That can be argued.
Okay, now I think Shukla ji has got disconnected, so I will continue with your permission.
Sir, मैं एक query पूछना चाहती हूँ, मैं एक query put करना चाहती हूँ.
हाँ मैडम.
Sir, one SSC has sold the property and he is entitled to Section 54 benefit, and he has invested 50 lakhs in bonds of Section 54 EC as well. Assessing officer is giving benefit of only 54F and not 54 EC. Second thing, for the purposes of 54, proportionate benefit is available, and for 54 EC, that is out of capital gain, so full benefit. So how to resolve this controversy? Whether first 54F to be applied and thereafter 54 EC, because I want to apply 54 EC first, so that capital gain would be reduced from 50 lakhs, and thereafter 54F can apply, then it would be more beneficial. So how to resolve this controversy? First, whether both are available, and the next query is...
Undoubtedly, both are available. Undoubtedly, both are available.
Assessing officer is not giving that. So
No, there are several decisions. There are several decisions of high courts to the effect that yes, both are available, and neither section is saying that the other will not apply. Right? So both are available. Now coming to your second part, that which one should I compute first? Now, one One simple logic could be 54 comes before 54 EC, therefore apply 54 first. That is.
Then SSC would be at disadvantage.
But this is not correct, because wherever legislature wants this to go seriatim, it does mention that. Example, you have you add moderate rules, and in service tax also they said that whenever there is a conflict, you go serially in classification. So wherever legislature wants me to follow a particular serial order, it does allow me. 54 and 54 EC, both are exemption provisions. Second rule of interpretation, that exemption provision is to be construed liberal. Second, whenever there is a doubt, the dispute has to be resolved in a taxing statute in favor of the assessee, never in favor of the revenue. Assuming I'm wrong everywhere, if I presume that both sections apply, but there is no mechanism. Madras High Court in 7 ITR, way back in 7 ITR, in Bosoto Brothers says that when two methods are available, adopt that one. The assessee has the right to choose which one he wants to follow. So if an assessee prefers that, he can rely on Madras High Court and say that I am choosing to take 54 EC first and then 54.
Thank you.
Thank you, madam. I think Mr. Shuklaji's connection is out, so I will just go. Last two queries we will take because we are already short of time. If the flats are allotted by the builder to the leasehold right owner as a consideration towards the sale of leasehold right, then will the income from the sale of those flats further by the leasehold holder go under capital gains or PGBP, and what will be the cost of those flats to the leasehold?
Now, when leasehold rights are transferred and flats received, and subsequently those flats are sold, that's the question. So I am the owner of leasehold rights. I am transferring those leasehold rights. In consideration of transfer of leasehold rights, I am getting flats, and at a later date, I am going to sell those flats as well. Now, these are two separate transactions, two independent transactions, so to say. Now, what do you do in such cases? First, compute capital gain on transfer of leasehold rights. When you're computing capital gains on transfer of leasehold rights, the consideration is flats which you are receiving. The market value of flats which you are receiving is the full value of consideration for transfer of leasehold rights. So if I take an example that 100 rupees is the cost of index cost of leasehold rights, the value of the flats which you have got is 10,000 rupees. So 10,000 rupees minus 100 rupees will be your long-term capital gain on transfer of leasehold rights. These flats will continue to remain capital asset if your leasehold rights were capital assets and you have not exercised the option to convert them into your stock in trade. Thereafter, when you sell the flats again, your holding period, to my mind, will commence from the date when you got the flat. So that will be your benchmark to decide whether it is short-term capital gain or it is a long-term capital gain. Now, whatever consideration you receive from the sale of flat, your question now is what should be the cost of the flat? The cost of the flat will be what you have considered to be full value of consideration while computing transfer capital gain for transfer of leasehold rights, which is 10,000 rupees in our case, we said is the value of the house when I received it. So 10,000 rupees will represent the cost. You have a direct Bombay tribunal decision. This is a very common issue in New Bombay on Sidco lands, and you have several decisions of Bombay tribunal to this effect. I think Atul Puranik is one of them.
Okay. The next one is in case of redevelopment project.
Yeah.
What is the legal position in respect of TDS deduction on rent and the corpus fund paid to the members of the society?
Now, as far as rent is concerned, the only sections are 194 IA, because you are talking of a builder paying rent. Now, if builder has himself taken the flat on rent and then given it to the person whose flat he is redeveloping, then of course 194 IA will apply to the builder because he is taking the flat on rent and giving it. But normally that does not happen. What happens is that the builder pays lump sum amount to the flat owner whose flats are being developed, and he tells him, you go and find out. You go and find out the flat for yourself. In such a case, the TDS provisions for the developer will not apply. When that individual is taking a flat on rent, then the newly introduced 194I something will apply. IB will apply, because wherever 194IA does not apply, they have introduced the new section that if your rent is more than 50,000 rupees, then some amount of TDS is required. So you'll have to get into the provisions of 194IB. That is the flat owner. I mean, the flat owner whose flat is being redeveloped will 194IB will apply. As far as the builder is concerned, it will not apply.
Next question is for claiming exemption under 54F. Can the assessee construct any house property within 3 years, even prior to date of transfer of original asset?
No, even 1 day prior is not allowed. As far as construction is concerned, it has to be only after the transfer. Purchase can be before or after. Construction has to be after.
Another question is, indexation starts at which stage? Down payment or slab base or agreement signed?
Now, there are decisions either way. My personal view is that the indexation will start from the date the asset comes into existence. Because if the asset itself was not there, you cannot hold an asset. Your indexation is with reference to the date on which you are holding the asset. But there are several decisions contrary to the view I am expressing. But my view would be that the indexation has to be with reference to date of holding. Holding can happen only after the property has come into existence. And therefore, but if you are buying a ready flat from somebody who is reselling it to you, it would go from the date of token payment or date from the initial MOU which you made.
Now, last query. What will be the date of acquisition for calculation of holding period of 2 years for long-term capital gain? Whether it will be from date of agreement or date of possession? Because this is an issue which many are facing.
See, you have Bombay High Court in Bamboo's case, which says that it will be from the date of agreement. But and against that Bombay High Court, SLP has been dismissed. Therefore, you can treat that as the legal position. However, there are contrary decisions, and even that Bombay High Court has not considered several earlier decisions. So, unless somebody takes up the point that Bombay High Court in Bamboo's case is per incurium, Bombay High Court will continue to hold the field. Date of agreement is what Bombay High Court says.
Okay, thank you, Jagdish ji, for eloquently answering all the queries. I would like to welcome our AIFTP past president Ganesh Purohit ji and JD Nankani sir, who are also with us. Welcome, sir. And madam, your closing remarks for 2 minutes, please, because we are short of time. And so that Premlata madam, your closing remarks, please.
Okay. Sir, closing remarks. What should I say, that Jagdish bhai has given such a nice deliberation. Most of the queries have been solved, and it's a nice deliberation, enlightens on the subject. This is a very wide subject. There are so many issues, and for this, at least 2 days are required for deliberation. But in any case, in short period, Jagdish bhai have enlightened us very nicely, and we are thankful to them. So this is now over to Vijay.
Thank you, madam. I would like to thank all Jagdish ji for coming, you personally for having accepted my request, and Arvind ji for coming and moderating the session. Unfortunately, not getting connected. Just before going to the formal vote of thanks, there's one important announcement. Friday, friends, we have a lecture on force majeure and disruptions under the Indian Contract Act by Senior Advocate Vikram Nankani ji, and the chairman of the session will be Dr. MVP Mukti, our past president. So 11:30, I request you all to be present. The link should also be sent. It's an important topic, and we have got time to speak on that. That is our pleasure. And now I request our president of Tax Friend, Atam Tekchani ji, to close the vote of thanks. Atam bhai.
Hello, everybody. First of all, I will thank Jagdish Bhai. Jagdish Bhai, I have listened to you for the first time, but you gave beautiful, beautiful illustrations to work out our capital gains. I had also personally so many queries, but you have solved practically all of them. Now, if anything remains, I will be in touch with you personally, sir.
Thank you, sir. Thank you.
Coming to Premlata Bansal, please. Madam ji, namaskar.
Namaskar, sir.
Thank you for your start and giving a few tips on how the capital gain and 50C is workable. This is a very interesting topic, and we'll try and continue the subject if the lockdown proceeds further. Thank you, Nankani Saab. Thank you, Ganesh Prohit sir. And thank you, everybody, for your contribution and knowledge given to all of us, sir. Thank you once again. Thank you very much.
Thank you, Atamji. I recognize the presence of Narayan Jain ji also from Kolkata. Welcome, sir.
Sir, welcome. Jain sir, welcome.
And
Yes, sir.
as the indications are there, the lockdown will be extended. So we will be announcing again a new series also from next week. Our lectures, as you all know, are Tuesday, Wednesday, and Friday, 11:30. We'll keep you updated. Thank you very much for all coming. Thanks, sir.